For years, Americans have been told the same thing. Just wait. Wait for prices to cool, wait for mortgage rates to fall, wait for housing to become affordable again. Now in 2026, a new report from Zillow suggests that moment may finally be approaching, at least on paper. According to their latest forecast, housing costs are expected to ease in nearly every major US market this year. But here's the problem. Affordable doesn't always mean attainable. In this video, we'll break down what Zillow's small wins year really means for buyers, renters, and retirees, and why many Americans may still feel locked out of the housing market in 2026. For years, Americans have been told the same thing: just wait. Wait for prices to cool, wait for mortgage rates to fall, wait for housing to become affordable again. Now in 2026, a new report from Zillow suggests that moment may finally be approaching, at least on paper. According to their latest forecasts, housing costs are expected to ease in nearly every major US market this year. But here's the problem. Affordable doesn't always mean attainable. In this video, we'll break down what Zillow's small wins year really means for buyers, renters, and retirees, and why many Americans may still feel locked out of the housing market in 2026. But even as monthly mortgage payments slowly improve, one major obstacle remains firmly in place: the down payment. Zillow's affordability forecast assumes a 20% down payment, the traditional benchmark used in most housing models. In 2026, that means putting down roughly $71,800 on a typical home priced around $359,000. For many American households, that number alone is enough to stop the conversation. Even buyers who can technically afford the monthly payment often struggle to accumulate that level of cash, especially after years of inflation, rising insurance costs, and higher everyday expenses. This is where the affordability narrative begins to break down. A home may be considered affordable on paper, but still completely out of reach in practice. Zillow's own economists acknowledge this disconnect. While housing costs may ease slightly, access to home ownership remains uneven, favoring buyers with existing equity, dual incomes, or significant savings. For first-time buyers and late-stage renters, the barrier isn't always the monthly bill. It's the cash required just to get in the door. Affordability in 2026 is not improving everywhere at the same speed. According to Zillow's forecast, the biggest gains are happening in parts of the Midwest and the inland South regions that never saw the extreme price surges of the coasts. Cities like Chicago, Atlanta, and Raleigh are now expected to meet Zillow's affordability benchmark in 2026. These markets share a few important characteristics. First, home prices are lower relative to local incomes. Second, builders were able to respond more quickly to pandemic-era demand by adding new inventory. And third, rent growth in these regions has begun to cool, which matters more than many people realize. When rent growth slows, it puts natural pressure on home prices. If renting becomes a viable alternative, buyers are no longer forced to overpay just to avoid rising rents. Zillow points to a surge in multifamily construction over the past 3 years as a key reason affordability is stabilizing in these markets. More apartments mean more options, and more options mean less pricing power for sellers. But the story looks very different on the coasts. In markets like New York, Los Angeles, San Francisco, and San Diego, mortgage costs are still expected to consume more than 50% of the median household income. In these cities, limited housing supply, high insurance costs, and long-standing demand keep prices elevated, even as rates ease. This is the emerging divide in the U.S. housing market. Not owners versus renters, but flexible markets versus constrained ones. While affordability is improving in parts of the country, some markets remain fundamentally out of reach. According to Zillow's 2026 forecast, mortgage costs in 5 major U.S. metro areas are still expected to consume more than 50% of the median household income. Those markets include New York, Los Angeles, San Francisco, San Diego, and San Jose. At that level, housing is no longer a budgeting decision. It becomes a structural barrier. In these cities, even modest homes require incomes far above the local median. or substantial outside wealth. Several factors keep these markets locked in place. Housing supply remains severely constrained. Zoning limits new construction, especially single-family homes. Insurance costs, particularly in coastal and wildfire-prone areas, continue to rise, and long-standing demand from high-income earners prevents meaningful price corrections. Even as mortgage rates ease, these forces cancel out most affordability gains. For many residents, the result is a permanent renter economy, or a decision to leave altogether. This is why national averages can be misleading. A small wins year for housing does not mean relief everywhere. In some cities, affordability hasn't just stalled, it's broken. To understand how fragile affordability really is, Zillow points to one market in particular: New Orleans. Unlike most major cities, Zillow expects home prices in New Orleans to fall sharply in 2026, by as much as 4.5%. That may not sound dramatic, but in housing terms, it matters. Zillow estimates that this drop alone could reduce monthly mortgage payments by more than $100. So what's driving the change? The answer isn't demand. It's inventory and insurance. Homes in New Orleans are taking longer to sell. Inventory is up roughly 20% compared to last year, and rising insurance costs are quietly reshaping buyer behavior. When insurance premiums rise, buyers don't just pay more, they qualify for less. That reduced purchasing power feeds directly back into lower home prices. New Orleans shows what happens when affordability improves, not because conditions are better, but because costs have pushed demand away. So, what does all of this actually mean in real life? For buyers, 2026 may feel less hostile, but it won't feel easy. Monthly payments may stabilize, but down payments, insurance costs, and property taxes will continue to separate who can buy from who cannot. For renters, the picture is slightly more encouraging. In many markets, slower rent growth is giving households breathing room and time. That time matters, because in today's housing market, flexibility is becoming more valuable than ownership. And for retirees and pre-retirees, the message is simple: where you live may matter more than whether you own. Markets with stable costs, manageable insurance, and predictable taxes are becoming safer choices than high-growth, high-risk cities. In 2026, housing isn't about timing the market, it's about choosing the right market. The housing market in 2026 isn't collapsing, and it isn't fully recovering either. It's adjusting. For some Americans, that adjustment brings small relief. For others, it confirms a hard truth that affordability depends less on timing and more on location. In the years ahead, the smartest housing decisions won't be driven by headlines. They'll be driven by stability, predictability, and long-term cost control. Because in housing, the most expensive mistake isn't buying too early, it's choosing the wrong market.